All right, welcome back everyone to Lunch at the Market. Each month presents us with a new battleground for us. In January it was Deckers, which smashed through the 75 strike where we were short puts. In February it was Molly Corp annihilating the 46 and 45 strike puts where we were short, which turned profitable trades into must rolls. Last year it was Visa, Goldman Sachs, NetFlix. You get the picture. And that doesn't even talk about or count BVN and GDXJ and those nightmares that we've been having for months as gold sold off in January. Because of how we trade over here at MOF, it's inevitable that at least one of our positions will not go the way that we want it to, and we'll have to take action during the month. We got some questions from @OS_EM on Twitter about our NetFlix trades for March. Looking at the 3-month chart, the last line in the sand that we can see is just under 205, somewhere around 204.92 or so. If this breaks, then there is every reason in the world to believe that Netflix will trade all the way down to 190 and fill the gap. If you go back a couple months, you can see there's a big gap up from 190 above the 200 level, above that 205 level, and there's a good chance that if it breaks 205, then it's going to go down to fill that gap. Okay, fill the gap means there's a gap in trading, so it'll trade all the way back down until it fills that gap, and then the gap will be resolved and the stock will trade somewhere depending on underlying fundamentals. Okay, there's no mistaking that there's risk involved in selling the 200-195 put spreads that we are short today. We sold a ton of those today. We got a great price for them, 120, around 120, 115, right around in there. After lunch, we got even more for those, around 140, 150. So the reality is that there's every reason in the world to believe that Netflix will break that 200 strike. But here's the thing, if it doesn't, then obviously today will end up having been the best day to sell that strike. Because we're okay rolling some of these trades out on the calendar, we don't mind taking on the risk today, knowing that we have more than enough cash firepower to make that roll out and down and out to another month. Look, eventually the market will reach a price where the stock won't go below that. So as long as the market stays in the current uptrend that we're in, there's no reason to believe that at some point all good stocks won't find the floor. And we believe that the stocks that we trade on, because we do so much homework, are good stocks. So usually it's a matter of time frame, when, not if we're profitable. And so we don't mind making some trades out into the future because we don't mind sticking around the trade until we're profitable. Have always considered ourselves value investors here at Magnum Opus Financial, and doing short put spreads in the current environment is our favorite way to be a value investor. It means we don't have to take on all the risk of outright owning the stock, which commits higher levels of capital, and it doesn't have a built-in hedge. When you do a short put spread, because the put spread is short the top side and long the bottom side, you have a hedge on every single transaction that you do, so you already know what your max loss is if you have to take it. We like that about short put spreads. Whereas right now, with the markets being where they are, we would just rather quantify our risk, quantify our returns, rather than take on all the risk of owning long stock positions. It's very capital intensive. This allows us to be more nimble than we were last year and make bigger profits because of the leverage that options employ. All right, on Netflix, the move from basically 205 to 247 was about $42. A 50% retracement of that move would have been down to 226, which Netflix has already shattered. A 67% Fibonacci retracement would have been down to 218.86. It's already blown through that, and so again, we reiterate that if it breaks that 205 on a closed basis and holds below that, then again, there's every reason in the world to believe that we see Netflix down at 190. All right. Goldman Sachs took us 6 months last year to get it to profitability. That is what good trading and investing is about. You do your homework, find good companies, and then you place your bet. Then you manage your trade until you either reach a profit target, the time that you want to be in the trade, or a percentage gain. And then you just take the trade off. It's turning a trade into an investment or an investment into a trade that really gets you in trouble. So unless you believe you're just simply flat out wrong and you need to take the trade off altogether, stick with it until you get to profitability. This reminds me of the concept of the profit gap that Jared Levy talked about with us on the first episode of this season's America's Favorite Traders, Season 1. If you missed that episode of America's Favorite Traders, just go to magnumopusfinancial.com, click on the America's Favorite Traders. You'll see a picture of Jared Levy's face, Patty Edwards, and James Altucher right there. check out that episode. You can either listen right there on the website or follow the link to download it directly from iTunes for free on any iDevice. It's really important to realize that psychology and trade execution are incredibly important when it comes to realizing your profit gap. That's how you close the profit gap, which is really the difference between what the strategy you put on should make and what you will probably make out of the strategy. What we try to do, what Jared's book that comes out on March 11th is all about doing, is trying to close that gap so that you achieve as much of the profit potential of your trade as you possibly can. For more details, check out Jared Levy's episode of America's Favorite Traders, and don't forget to pick out his book, My Options Handbook, which comes out on March 11th from Wiley Press. Other than the Akamai short 45-40 put spreads, which we just simply found the other day in our portfolio, we did roll those out, down and out. Other than that, we are sticking to our guns. Just because you're seeing 2 days in a row of red on your screen doesn't mean that everything that you believed last week is all of a sudden not true anymore. So look, market psychology and trade execution are just as important as the ideas that you have for why you pick the trades that you do. So exercise some judgment. If you feel more comfortable if you have profits, by all means, take some of those off the table and reduce your exposure overall to the market. That way you can concentrate on those positions that are giving you trouble. If you're completely and totally and utterly wrong, by all means, cut your losses and move on. Don't stay in a losing trade. But if it's simply a matter of rolling down and out and waiting for your thesis to be true, don't bail on a good idea just because you're going to have to be in it longer than you'd hope. Unless, of course, you intended it to be a trade, and again, you're wrong. So a lot of it's a matter of time frame. It should always be a matter of temperament. Never put a trade on that doesn't match how you as an investor feel about the market, about the way you think money should work. All right? So check out our first episode of America's Favorite Traders with Jared Levy. Tune in next week. We have a guest on the show this Friday. We'll have the new episode of America's Favorite Traders out next week. We'll have that update for you on magnumopusfinancial.com. Thanks for tuning in again today. Nobody hit the red button and run for the exits. There's no reason to panic. Just be prudent. Make sure you have your hedges on and always have lots of cash. Thanks for joining us again today on Lunch of the Market, and we will see you tomorrow.